Right now, as we look across the financial landscape, Indian equities are sitting precariously near all-time historic highs. Pouring your capital purely into stocks at these valuations carries a severe risk. If the market corrects, your portfolio takes the full, unfiltered hit. This chart isolates a sharp V-shaped price drop, illustrating what we call a maximum drawdown. It is the exact percentage your portfolio drops from its highest peak to its lowest trough during a crash. History shows us that during massive systemic shocks, standard investment strategies break down. They fail to protect your capital when you actually need it. You need a place to park your capital that still captures growth, but keeps you safe from a catastrophic market reset. Surviving a market peak means shifting your priority. You have to focus on downside protection first, and absolute peak returns second. Many investors think they are safe because they spread their money across large, mid, and small-cap equity funds. This heat map shows the flaw in that logic. The dark red blocks indicate a 90% plus correlation between large, mid, and small caps. When a systemic crash hits, they all plummet simultaneously. The mathematical solution to this is multi-asset allocation. These funds are built by mixing assets that don't react the same way to market panics. Instead of just Indian stocks, these funds balance your exposure with debt, international equities, and commodities like gold, which hold value when stocks fall. Look at this historical chart comparing the two paths. In the 2008 financial crisis, the Nifty 50 plunged 59%. A standard multi-asset mix fell only 27%. In the 2020 crash, the Nifty dropped 38%, while the multi-asset approach limited the damage to just 18%. Vanguard data shows up to 90% of a portfolio's long-term returns rely strictly on this high-level asset allocation, not by picking individual winning stocks. True diversification requires blending entirely different asset classes. Mixing different equity themes is just buying the exact same risk in different packaging. The math behind the multi-asset category works, but looking at the dozens of funds available in 2026, you will find wildly different internal strategies. Choosing the right one forces you to make an explicit decision. Exactly where are you willing to compromise between absolute safety and maximum yield? This quadrant chart maps the trade-off. The horizontal axis measures safety, your 1-year maximum drawdown. The vertical axis measures growth, the 5-year return. Plotting the top 5 funds of 2026, they don't cluster in the middle. They scatter across the extremes. There is no universal best fund. Its position determines who should buy it. Let's examine HDFC Multi-Asset Fund. Its dominant trait is downside protection, capping its maximum drawdown at negative 8.9%, while delivering a 16.61% return over 5 years. It builds this cushion by heavily weighting its portfolio, nearly 46%, toward defensive financial stocks. That ensures a swift recovery from market corrections. The trade-off is clear. By prioritizing defense, you cap upside potential, underperforming pure equities during bull runs. On the extreme side sits ICICI Prudential. Engineered for maximum growth, it pushes an 18.19% return with a negative 9.51% drawdown. To manage its massive 84,000 crore asset base, ICICI utilizes a much heavier equity approach to force high compounding. To get that 18% yield, you must accept the turns, a higher baseline volatility of nearly 9.6% and slightly deeper temporary losses. The choice between HDFC and ICICI comes down to your personal priority. Do you value sleeping well at night during a panic, or do you want to maximize the final number on your spreadsheet? Then we have the outliers. Look at Kotak Multi-Asset OmniFoF, which suffered a massive 15.34% drawdown. Kotak relies aggressively on high-performing infrastructure ETFs. That concentration defeats the purpose of the multi-asset category. You take on pure equity-level volatility, but you don't get the associated rewards. Structural fees are another blind spot. Take the ICICI Prudential Asset Allocator. On paper, it reports a tiny 0.19% expense ratio. But because it is a fund of funds, it has hidden costs. While the top-level fee is low, you ultimately bear the underlying fees of every mutual fund it buys inside the portfolio. Navigating the 2026 landscape means matching your personal risk tolerance to the data matrix. If you are a near retiree terrified of losing 15% of your nest egg overnight, your primary goal is capital preservation. Your strict recommendation is the HDFC Multi-Asset Fund. Its mathematically superior downside management will protect your capital when the market corrects. If you have a 5 to 10-year horizon and accept a bumpier ride for maximum yield, you are an aggressive compounder. Your recommendation is the ICICI Prudential Multi-Asset Fund, built to capture that 18% historical growth rate. The strict rule to remember: if a fund reports drawdowns higher than 10 to 12%, it fails the fundamental test of this category. Trying to capture maximum equity level growth with zero downside risk is a mathematical impossibility. A successful investment at a market peak doesn't come from finding a flawless fund. It comes from finding the perfect compromise for your personal reality.